Welcome back to the Neuro Finance Masterclass, and welcome to day 89 of our 365 Days to Financial Freedom series. Today, we're locking into a brand new explainer theme that we like to call Buying the Concrete. We're going to dive into exactly how you evaluate a company's real, physical, undeniable worth. Once all that wild market hype gets completely stripped away. So here's our syllabus for today's explainer. We'll be hitting the physical anchor, defining book value, the P/B ratio formula, reading the thresholds, and finally wrapping up with the asset audit. All right, let's jump right into section 1, the physical anchor beyond the earnings. Usually, we spend so much time focusing heavily on earnings and daily profits, right? But here's a massive critical problem we all run into in the markets. What happens if a company simply doesn't make a profit? Seriously, how do we actually value a business when it just has an awful year and posts an absolute zero in profit? Because it doesn't just suddenly become completely worthless overnight. Think about it. You might have a struggling company, but it happens to own billions of dollars in land, sprawling factories, or heavy machinery. Those massive physical assets just aren't going to show up in a quick glance at its daily cash flow. So, to avoid getting totally wiped out in hollow tech bubbles that can just vanish into thin air, we really need to look for that physical anchor, the tangible, physical reality of the business itself.
Which brings us to section 2, defining book value, the concrete reality.
Now, if you're trading in local markets, you've probably heard this referred to as öz sermaye. Book value is quite simply the net worth of a company according to its financial accounting books. It is the concrete reality of what the business actually owns. It's kind of like buying this old rundown house, but it has hidden gold stashed inside the walls. The casual observer might only see the peeling paint, which is like a bad quarter of earnings. But when you actually know the book value, you discover the tremendous solid worth hidden right there inside. To really visualize this, I want you to imagine a company completely halts its operations today. Step 1, they lock the front doors. Step 2, they sell off absolutely every single piece of land, every building, and every bit of inventory they possess. And step 3, they pay off every single dollar of debt they owe to the banks and bondholders. Whatever cash is left sitting right there on the table at the very end of the day, that is your book value. Let's move on to section 3, the P/B ratio formula, the math. Okay, let's translate this super concrete concept into our primary mathematical tool. We're talking about the P/B ratio, or as it's widely known in local markets, the PD/DD. Piacere over defter deity. The formula here is beautifully simple, yet it's incredibly powerful. We just take the company's current market capitalization, that's what the stock market says the whole company is worth today, and we divide it by the total book value, which is that giant pile of cash we literally just calculated. And the number this spits out? It's profound. In really simple terms, this ratio tells you exactly how much the stock market is charging you right now for one single dollar of the company's net physical assets. Think about it. Are you paying 50 cents for that dollar? Or are you getting ripped off and paying $10 for that same dollar? Let's figure out how to read that in section 4, reading the thresholds, the architect's guide. So we absolutely have to contrast how the market prices different types of businesses here. Asset-heavy traditional industries like banking and industrial manufacturing, well, they operate very differently from asset-light companies. For instance, a high-growth software company might sit at a P/B ratio of 5.0 or even 10.0 and way above. And honestly, that's completely normal because their core value comes from intellectual property, patents, and code, not from steel and factories. But wait, look what happens on the total opposite end of the spectrum, a PD/DD below 1.0. This right here is widely considered the absolute holy grail of value investing. It means the stock market is literally valuing the entire company at less than its physical assets are actually worth. It's exactly like buying a wallet with a crisp $100 bill inside for only 80 bucks. Mathematically speaking, if the company liquidates tomorrow, you theoretically make an instant profit. Now, there is a really crucial caveat we've got to keep in mind here. You can never, ever evaluate this ratio in a vacuum. You just cannot compare the P/B ratio of a massive steel mill to a tiny cloud software startup. That's a completely flawed analysis. To see who is truly undervalued, you must compare banks to banks and compare tech to tech, staying strictly within the exact same industry context.
Which leads us to our final part today, section 5, the asset audit, your cognitive task. To really lock this all in, a fantastic exercise to do right after this explainer is to just open up your financial screener. Go look up the PD/DD ratio of a massive industrial manufacturing company and then put it side by side with a high-growth software company. Notice the stark difference. You'll see firsthand how the primary value driver completely dictates what a normal ratio looks like for each of them.
Establishing this baseline every single time you look at a stock is an amazing tool for your neuro fitness. You should never invest blindly in a traditional business without knowing exactly what you are paying for the underlying concrete. Build on facts, calculate that baseline, and you will rule the cycle.
So when you're looking at your next potential investment today, I want you to ask yourself, are you buying the underlying assets at a massive discount, or are you paying a really dangerous premium for the brick and mortar? The answer is sitting right there in the math, just waiting for you to uncover it. Go find that hidden gold.